All right. Good Monday evening and happy Martin Luther King Jr. Day. Investors, hope this extended weekend has found you a little more relaxation before markets open for trading on Tuesday or even futures open later this evening. With that being said, just kind of a little walk through some of my latest thoughts. For Phenom Group members, a little bit of a recap and or additional context regarding this weekend's past um, macro market research report titled "Quickly Going Nowhere with a Dirty Market Dynamic." And so, what I essentially mean by that is there are a lot of unusual circumstances taking place in both the macroeconomic landscape as well as the market landscape. They've happened rather quickly, and because they are unusual, and it's a very murky environment that folks haven't a lot of experience with. So it's a bit of a dirty and muddled picture that investors and traders alike are trying to, for that matter, strategists and analysts alike, trying to come to grips with, if not, understand the path forward. We'll go through some of my latest thoughts as usual. None of this is pre-rehearsed, so there may be some pauses in between as I, look through different materials, if you will. Um, so this is our weekend macro market research report. Our Phenom Group contributor and premium members have access to this. The regular public, or the general public, I'm sorry, doesn't. So with that being said, and as usual, subscribe. Subscribe if you want to check out our 2026 Outlook report and all of our weekly research reports. Under the research report tab, you'll have access to all of our data analytics, my thoughts, our trade ideas, our investment ideas for 2026. And you can go all the way back in the archives to 2018 and see how well we've done over the years. So with that, we'll just kind of scroll through some of the latest data to see what's what. We had been tracking this particular quant from the famous Wayne Whaley with regards to last week's price action, and going into last week, this particular quant was a perfect 7-0. But with the down week that we did see last week, it's now 7-1. And this is basically just evidence that quants can fail for the first time, ever. And this one goes back to 1986, but essentially it spoke to we had a 10 when you have a 10% year or 10% greater year like we did in 2025, but finished with a negative last week, i.e., the last week of December 2025, and then you follow it up with a positive week in the first week of January, which we had. Typically, you see the 12th through the 19th of January, which was last week, positive, 7-0. It just didn't happen this time. But this doesn't mean that you throw in the cards on quantitative analysis, quantitative data, and quantitative trading and investing. It just serves to figure that you have to take into consideration a variety of factors and recognize this was a very short-term consideration so far as the quant was concerned. It's basically just looking at the probabilities for 1 week forward. Secondly, it's a small sample size, and while you don't control sample sizes, that's up to history. It lowers the significance rating for this particular quant. So failed for the first time, and we just move on, right? As an investor trader, you should always be of the mindset, if you're doing anything in the near term with quantitative data, what you do in the near term should also be attached to your long-term views, goals, and objectives. It's kind of like one of my rules of investing, which is only trade that which you're willing to own. So if you do get caught in a situation such as this, where the quant fails, you're okay. You wanted to own it anyway. Um, this past week also ended or officially ended the toy barometer period. And I'm sure you've seen a lot of posts, including mine, out there in social media. And I had been tracking it since the beginning of the toy barometer period, which starts in November of the calendar year, i.e., 2025. So November 19th of 2025 through the turn of the year, i.e., toy. That's what toy stands for. It's an acronym for turn of year. January 19th. Now, the 19th would have fallen on a holiday today. So technically, it ends, the toy barometer period ends the Friday before, or the trading day before, which was last Friday. And so within the toy barometer period, the S&P 500 gained greater than 3%, greater than 3%, which equates to a bullish toy barometer. So if you gain more than 3% or greater from November 19th to January 19th, it's a bullish toy barometer. The other categorized toy barometers would be neutral or bearish. Bearish is if you had a negative return from November 19th to January 19th. But that's out of the way. We got a bullish toy barometer, and every time, well, here's the data regarding the other or prior 38 occurrences of a bullish toy barometer, and we've only had two negative forward 12 month returns, negative returns. And that was 1986, 1987. So November 1986, turn of year, 1987, we had a bullish toy barometer, but 12 months forward, the market delivered a negative return. Similar here in 2018, a negative 4.97% return. So when you take the total number of occurrences, you have 38, of which two were negative. So that's 36 and 2, giving you about a 96% positivity rate, which, with a rather substantial sample size and positivity rate, informs investors and traders alike that it would behoove them if we spend any time, it doesn't, any time below Friday's closing price between now and the 12-month forward period, those are all buying opportunities. You say, Seth, well, what if we're 10% below Friday's close, right? You're looking for a correction this year, Seth. That's part of your outlook. My answer would be, did I stutter? Right? This is the data. This is what the data tells you. So if you're going down 10%, if you're expecting a correction 10% below Friday's closing price at some point in time throughout the course of 2026, manage cash wisely, right? Don't just blow all of your cash this coming week. If we find ourselves down 1%, 2%, no, layer into it, right? I would be of the opinion the best approach, thinking of just the index ETF, SPDR, or even QQQ for the NASDAQ 100, every 1% down the market goes, adding 1%. That's how I played it last year during the course of the tariff tantrum or tariff technical bear market. I was just layering 1% all the way down until we got down, 20%. And that last tranche was a 2%er. So, having the biggest tranche in hindsight being the low, also proving great cash management and tactical game plan. So 96% positivity rate, in thinking of a couple of different quantitative data sets that we came into the year either tracking or understanding were part of 2026's calendar year. This one firing, bullish at the onset of the year gives us that much more conviction with cash deployment during any part of the year and during any pullbacks and or corrections. We have another quantitative data set in mind for essentially the final quarter of the year. putting those two together definitely emphasizes cash management, but prioritizes buying the dip. You have to be willing, right? And that's really, when it comes to investing, it's not so much what you know, because that's what you get a lot of here out of our video. You get a lot of that, of course, out of your subscription to Phenom Group, but how to behave. You might even get that out of my X feed post throughout the course of the week. It's really great. I mean, you got the knowledge, but if you don't know how to behave and if you can't behave the way you should behave toward price action, in one ear out the other, or all of this is worthless if you can't express the behavior that you need to express. If you can't hit that buy button because you're trying to minimize drawdowns throughout the course of the year, hoping that you can buy it back lower, but that generally fails as a strategy. It generally fails. Investors have only two buttons to choose from. They wish they had a third button, which was minimize, right? Hit that third button, which is to minimize drawdowns, but that button doesn't exist. We fool ourselves into believing our actions can make that happen. It's more ego than it is rooted in any substantive data about human behavior or behavioral finance. So the other thing I'm also proud to know. Now, this is also something I want to emphasize when it comes to the Phenom Group price target. So last week I had recognized and posted, maybe we can go to that. I had posted out that we had seen a savvy overbought condition by way of a sentiment reading in the NYSE. So NYSE being a broad market basket of stocks and or ETFs had hit a very high level or an extreme level, if you will, with regards to sentiment. And there it is. Yeah. So the bullish percent, and this is just a sentiment index, bullish percent index on the NYSE got to nearly 70 as of Thursday's close into Friday's session. And historically, when you get up to these levels and even breach, this is very hot levels up here. We don't stay up here for very long, and price tends to consolidate within the coming days. And I'm sure most of you have seen futures pricing this morning into this afternoon and recognize that futures were down substantially, greater than 1% on the NASDAQ, about 1% on the S&P 500. And a lot of you are probably saying to yourself, well, that's because of a lot of the angst regarding President Trump's threatening tariffs again on many of the European Union nations because they want a deal on Greenland. So that's why. It has nothing to do with the overheated NYSE bullish percent index. Even though Friday's market session, we wound up down across the major averages. I would say no. Like you're kidding yourself if you think this has anything. If futures open down, if we're down on Tuesday's open market session, folks, the market doesn't reprice. Okay, it went through the tariff tantrum already. All right, this threat of additional tariffs or new tariffs on the European Union, and by the way, that would constitute another deal break from President Trump and the White House administration, which doesn't help when it comes to future negotiations, i.e., this year's negotiations on USMCA with Canada and Mexico. Like, that's all that you can't deal that's why these were never really deals with the European Union. We implemented tariffs. That's all that happened. We implemented tariffs. The deal was so far as how much those tariffs would be. But that's not a deal. That's just implementing tariffs. That's why we only got about 9 deals out of 90 countries. We're not living up to the our end of the bargain now. If we're threatening new tariffs, it essentially breaks the old quote unquote deal. Um, but it also serves to say it wasn't a deal. It was never a deal. Like, you can't have it both ways if you're supporting this nonsense. Oh, he told us 90 deals in 90 days, and we got deals. No, you didn't. You just had implementation of tariffs. In some countries, a lesser degree than others. And these actions today serve to validate, you did not get deals. So, with that said, and getting a little off track there, it has nothing to do with that, okay? The fund flows were set up such that we got to this overheated condition in the bullish percent index, and now we're just going to pull back. Markets don't reprice something that they found out in 2025 wasn't worth pricing in the first place. The tariffs didn't hurt the S&P 500 earnings. It didn't, not one bit. And even when analysts downgraded the earnings for the full year, by the early Q2 period, all they found themselves doing was ratcheting them back up for the entirety of the rest of the year. Markets don't do that twice, okay? So, no, I'm sorry. I get that, the media is pounding, down your eardrums this narrative that, we're going to be pricing new tariffs, blah, blah, blah. It's just not how it works. If anything, you could make a close argument that the market never priced in the government shutdown last year, right? The market essentially just kept moving higher, knowing that the government would reopen. It was just a matter of when. But maybe there's some consternation that if it happens again, depending on who feels, which party has the upper hand. And sad to say, most people at this point, now in a midterm election year, would be of the opinion the Democrats do have the upper hand. And I'm saying that as a card-carrying Republican. They are inclined to just, sit it out and get their deal, which is associated with healthcare. And so that could extend the next shutdown that much longer. And so you can make the argument that the market may want to pull back, a little bit more than just, if we do go down Tuesday, in recognition of that potential disruption. And unfortunately, if that does come to pass, which is not my base case, it really isn't. It's a matter of just maintaining low expectations. That's what savvy investors do. Just maintain low expectations. If the market outperforms, if government outperforms, great. You're long anyway. You're positioned for upside. Who cares? So, we'll see. We'll see what happens with that in mind. But this was going to be a pullback anyway. Fund flows were set up such that we were overheated, and now we'll get some digestion in the markets, which without leadership, you have to. And people have said, well, no, it's just a change in leadership. Small caps are not leadership. Mid caps are not leadership. Equal weight is not leadership. You don't have leadership without the largest, most heavily weighted areas of the market leading. How can you say that, Seth, that there's no such thing as a leadership change? Well, you have to have a destination, right? I mean, if that's what we're talking about, where are they leading us to? And is that level or is that destination sustainable? Is that goal sustainable? Folks, we've gone nowhere in this year, right? When you compare it to the high in December of last year, literally flat. To my point, where's leadership taking us? Nowhere. Hence, it's not leadership. No math can sustain this kind of rotational outperformance. And that's all essentially what you have, rotational outperformance. That is not the same thing as leadership. And it's a problem for, as I evidenced in our former video, it's a problem when it comes to the S&P 500 price targets that strategists have offered for 2026. And if we just look at it from the median strategist price target level, it's 75.60. Okay, 75.60 if this lack of leadership amongst the mega caps, amongst tech, amongst the S&P 100 persist, which is not my base case either, then if you do the math based on year-to-date performance of small caps, equal weight, the Qs, and the spider, it would essentially, if you do the math and compound their year-to-date returns, it detracts about 8%, 8 percentage points from the S&P's potential 2026 gain. What does that leave you with? Fortunately, and as I said, that's not my base case. It doesn't mean that the rotational outperformance can't survive the year, but rather the degree of underperformance from the most heavily weighted areas of the market starts to catch up, right? Bridges the gap, so to speak, and you get greater participation from the most heavily weighted areas of the market. All right, so yeah, I mean, and as I said last week, we're at a place where we're not making any progress with respect to last year's high. On a year-to-date basis, obviously, we were up, and the first 5 trading days were up. So we are positive on the year, but we can erase that in one trading day if the futures are foretelling Tuesday's open market session. And as I've often said, futures are dirty, filthy liars. They can be dirty, filthy liars. That's something I also say. As investors and traders, you put can in front of everything, right? Put can because the market can do anything. Often futures do not represent the open market session because futures are very illiquid. You have very minimal participation. And so, one future contract can move the S&P 500 futures, 20 points. I'm sorry, not 20 points. I was thinking of the NASDAQ futures. So also just recently, so our former price target of 6,800, we have now officially, which was a 6-month price target and a baseline expectation during the first quarter period, which we hold on to, right? That still exists through the end of the first quarter. 6,800 is still a baseline expectation, which we're not too far from, right? Still 2 weeks into the calendar year. But with the bullish toy barometer, and still yet what we see as very strong earnings potential for the calendar year, right? You put those two things together, a very powerful quant and a very strong double-digit earnings growth potential where the estimates are for calendar year 2026. And we are more encouraged and confident in now issuing a 12-month forward price target objective for the S&P 500 at 7,500. And so people say, well, that's still below the median price target, Seth. You're not, giving us a whole lot to chew on. And what I would say is, folks, please, okay, keep in mind, that the average, annual return over the past 20 years is about 9%. And that's essentially what this price target offers, in keeping with that median gain over the past 20 years, but also consistent with, what we're seeing in the lack of leadership participation, right? Detracting some of the potential gains regardless of earnings strength. But also, we are in a midterm election year where you generally, on average, have a greater than 17% correction, just on average. And we've had bear markets in each of the last 2 midterm election years, and I get it. Each of the last 2 also considered that we had the Fed hiking rates and doing quantitative tightening, and that's not the case this time around. What I would say is so, right? So you don't have that one thing, Fed. You don't have that one thing. That doesn't detract from what we've seen in the fund flow schedule through the back half of 2025, let alone the fact that we have three high double-digit return years that could possibly have pulled forward a lot of multiple expansion as well as returns. There's so much that can go into this. Thirdly, we haven't touched the 200-day moving. We haven't tested the 200-day moving average in any of the indices lately, right? And if we get to that point by April without touching the 200-day moving average, the probability that we will have, a double-digit correction, I mean, it just skyrockets. It skyrockets. So you're going to lose time, right? Corrections are really about you lose time. And so long as you don't hit the sell button and you just start to allocate dollar cost average, you're going to lose time, and that time inhibits the S&P 500's potential to achieve those double digit returns where a lot of Wall Street strategists are projecting 2026. So again, there's a lot of variables at play, but either way, hey, at this stage, are you going to cry over $7,500 S&P 500? 12 months forward? I don't think we're going to find many crying about that. So let's move on. And it is a midterm year, so in going through the toy barometer data, I wanted to see if there was anything that could throw it off, being that it is a midterm election year. And having a bullish toy barometer in a midterm election year happened once, twice, three times, four times, five times in now for the sixth time. And 2018 midterm election year, Fed was hiking, passive quantitative tightening, by the way, and there is a difference. In 2022, they were doing active quantitative tightening. In 2023, that's not the case. Again, that's not the case today. But 4 up, 1 down. Right? Odds are still in your favor and these are all double-digit returns, by the way. Video here, and you can go check that out on the Phenom Group YouTube channel. You can check out my video from 2021, fully explaining in detail, what the toy barometer is, how to lean into it, and whether or not you should lean into it, and how it worked again in 2021. We had a bullish toy barometer back then. 12 months forward, the market, of course, was higher. Quick and dirty macroeconomics, and one of the things that I get it. A lot of people, they label themselves or they try to pigeonhole themselves. If you ask me, well, I'm more of a macro trader investor. I use economic data to dictate how I allocate capital. And what I would say about that is okay, but I think I've already said you're pigeonholing yourself. The economy always rebounds. We spend less than 10% of our economic life in a recession. So I don't understand why certain investors would dedicate their capital allocation or predicate their allocations on the macro. Right? That seems like a waste of time. And Warren Buffett basically said the same thing, right? You're essentially trying to allocate by elevating or prioritizing the risk of consumer deflation, right? Then that's essentially a recession, instead of buying good companies, right? Hitting the buy button. So it's not that you shouldn't have an understanding, you shouldn't have an understanding of the macroeconomic landscape or backdrop. It's a matter of, okay, it's good to track it, but it shouldn't be your primer, right? It shouldn't be your stimulus for, how or when you allocate capital. And if Warren Buffett says so, I tend to agree. I don't agree with everything Warren Buffett says, but historically this has been a better approach to investing. Just buy good companies. The macro will take care of itself. It always comes back, right? Trying to avoid drawdowns for the sake of a potential recession that you perceive to happen based on your understanding of the macroeconomic backdrop and landscape going forward, that hasn't benefited anybody, over the course of their career. I mean, how many folks were, basically projecting 100% probability of a Biden, right? A Biden recession for 2023 that never came to pass. And how many people are looking at the leading economic indicator index or leading economic index now down to 3 calendar years without a recession? We've triggered 2 SOM rules without a recession. Inverted yield curve, uninverting the yield curve without a recession. The reality is we haven't had an exogenous event. And that's essentially what causes every single recession. There's really no such thing as a leading economic indicator. There's only coincidental indicators. In fact, there is a coincidental indicator, or a coincidental economic index. And it exists to remedy the quote unquote leading economic index. You get an exogenous or endogenous event of consequence, which shocks the economy, i.e., shocks the consumer, you get your recession. Until then, you've wasted a lot of time on your quote unquote macroeconomic fundamental capital allocation decision making. Nonetheless, and as I said, it's good to underwrite. I mean, you want to know, you want to track all the data, on a weekly or monthly basis, but I wouldn't prioritize it. A lot of this is just good cocktail party conversation and ways to look smart in front of your friends. But as I said before, it's about behavior as an investor. Behave right, get paid well. You can be the smartest person in the world. And remember, if all these things exist, why isn't everybody getting the same returns? Why isn't everybody outperforming? Because it's not the intellect, it's the behavior. Most people don't behave well when it comes to price action. It's not what you know, it's what you do. If you knew what was going to happen in the economy, you still wouldn't necessarily know what was going to happen in the stock market. And one way we can validate that is we've had, I think, 6 recessions, or I apologize, 4 or 5 recessions, and the market was higher in each of those particular recessionary years. 2020 was the most recent example. We had a recession. I remember Stanley Druckenmiller did a whole, podcast. I want to say in April, after the market lows, did a whole at the New York Economic Forum, did a whole podcast warning folks that this was likely going to get worse, and this rebound in the market was going to prove short-lived. Stanley Druckenmiller. I'll remind you, as one of the greatest fund managers of all time, there's never been an outside audit of his results. Not one. Let's move on. The things they say versus what you know. So we do cover a lot of economic data in here. Don't get me wrong, because again, I said, this is good stuff to know. You only know that your behavior matters more than the macroeconomic data you've studied, educated yourself with, and yet find has little relevance as it pertains to your performance as an investor or trader until you go through this level of education, right? You only know what you know. Let's see what else. Again, the switching strategy. Is it any surprise that the S&P 500 cap weight is lagging the equal weight this time of year? And since November 1st, to us at Phenom Group, this is exactly what we informed. Right? This is supposed to happen. It happens more often than not. The arrows here, don't know what color it is, uh, yellow, whatever. The arrows here represent the years where the quote unquote switching strategy, switching from the cap weighted S&P to equal weight S&P outperformed. Right? If you switch to the equal weight S&P, it outperformed where all the arrows are shown. That's the majority of years that we have here going back to 1991. So is this a surprise that equal weight is doing so well versus cap weight? Is this a surprise that small caps are doing better than large caps? Not at all. This is what tends to happen more often than not around this time of year. Small caps tend to outperform from December of the prior year through February of the new year. It happened just last year in 2024 into 2025. So is a lot of this rotational outperformance just seasonal? We can't necessarily say that, as an absolute without hindsight. All we can say right now is this is supposed to happen. It generally does happen. The average year, you get this kind of performance at this time of year. It's why I also said our base case is not necessarily to see this kind of rotational outperformance sustained through the bulk of the year. It can, but it's not our base case. It is more pronounced. If we look at just this chart here of the MAGs, the Magnificent Seven, which is the Round Hill Big Tech ETF versus the Russell 2000, like I said, happened December of last year into the new year, and it was sustained through May. A lot of that was due to the tariff situation, but the absolute decline was not that big and kept going, right? It was this fits and starts, fits and starts, fits and starts, and a really big bow whoosh. So one of the things that I have been mentioning all last week inside the Phenom Group trading room, which again comes with your premium membership to Phenom Group, all last week I was saying usually this kind of rotational outperformance doesn't end with another rotation out of the areas that are working, i.e. equal weight small caps, mid caps into big cap tech, Magnificent Seven, large caps. It doesn't generally work that way. You usually get a bow whoosh before you get the rotation of capital back into leadership. Said that all last week. Do not be surprised if, again, we only have futures to look at. If we get that bow whoosh, right, this pullback also predicated on the bullish percent index reading that I had just shown you, supposed to happen. It's supposed to happen. This is not about Denmark. This is not about Norway. This is not about Germany. This is not about a deal for Greenland. This is how it works. We pay way more attention to what's going on in the headlines when we should be paying attention to the history of markets and what tends to occur with price action, with rotations, with leadership this time of year. One thing that has us somewhat of the opinion, I would say, that the rotational outperformance may have legs through at least through possibly the first quarter into the second quarter of 2026 is that we actually extended the period of large cap outperformance so far as the numbers of consecutive years of large cap beating small caps. Going all the way back to 2011, this was the first year S&P had beaten the rut, Russell 2000, and then we had 2 years of underperformance, but then we had 2 years of outperformance, large over small. So 1 year, disrupted. 2 years, disrupted. Then 3 years, disrupted. then 4 years going into 2025, but we weren't disrupted. So there was a cadence here. One disrupted, two disrupted, three disrupted, four no disruption. So we extended this beyond the pattern broke. The pattern broke, and it extended probably too far through the calendar year 2025. So with that extension, we wouldn't be surprised if there was some mean reversion that gave more of a tailwind with respect to the disruption in 2026, whereby Russell should outperform the S&P 500 longer than just this seasonally appropriate period around the beginning of a new year. Follow? Right? It's a pattern. It got overextended. Now you finally have some disruption that may have legs. We'll see. Long year ahead of us, folks. All right. A lot of quants here, for our members. They know what to do, go through them. They know the dates. They know the levels to be looking for, up or down. I mean, it's all here tracked. Every week we do a big review, breaking it down by S&P quants and VIX quants, NASDAQ 100 quants. We often get, question, can we do a spreadsheet? Can we do something with AI that, a dedicated page and things like that? And, I say, I mean, that's all fine, well, and good so far as, attempts to find a better way to keep certain quant data front of mind and what have you. But what I'd encourage you to consider is what you're really asking of yourselves in terms of trying to track the data and keep the quants that should be front of mind. Is all you're really talking about is looking at it somewhere else. That's it. That's all you're doing. You're looking at it on a different page. You're looking at it in a different form. And realistically, whether it's, and quants can take different forms, shapes, and sizes, whether it's a line chart, pointing to different prices, or it's a table, identifying, months, dates, and returns, averages, things like that. It's just different form factors. And where you read it is really all you're talking about. How and where you read it. One page versus another page. One form factor versus another form factor. So, I get it. People want to believe that there's some higher intensity cognitive capabilities. And in the AI era, we're just becoming trained to believe that AI is better. Right? Everything we do with AI is actually human genesis. But we tend to think that we put it into some kind of AI, search engine or algorithm, and it becomes better. Right? When we sit down and rationalize these things, we understand there's little rationale to it, but we do have to kind of go through that exercise. So anyways, with that being said, I talked about consumer staples. It's one of my investment ideas for 2025. Stock specifically, Pepsi, and the ETF itself, which I own in a structured investment vehicle. Again, just reviewing some of this, within our macro market research report this weekend. But a lot of these cyclical and just the everything trade. Right? Everything's doing well outside of the Mag 7, outside of large cap tech growth. Most everything is doing quite well, including consumer staples. Whether it's defensive or not, most areas of the market are doing quite well. But staples specifically have gotten overheated, overextended. I'm looking for a pullback. Even though I own it, I know things don't go up in a straight line. I'm looking for a pullback, and I'm more than likely going to take advantage of that pullback. So just kind of, this quant right here outlines, that probability is more than likely. If we look out 2 and 3 months, 2 months it's a toss up. Even 1 week returns going forward, it's not looking good. The average and median return are negative, and you only have a 33% positivity rate. So the probabilities that we get a pullback, in certain areas of the market specifically, they're high. They're not guaranteed, right? We don't use quantitative data as a guarantee. We use it as a understanding the probabilities going forward. If you were going to Vegas, you'd like to know your probabilities. What's my probability if the first two cards that turn over are 20? In blackjack, what's my probabilities of winning this hand? You probably want to know that. And while we emphasize that earnings drive markets over time, we do also need to respect. And I'm sorry to segue here so quickly. You're like, whoa, 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 whoa! Earnings now? Okay, we're on earnings, Seth. Because I often preach, hey, markets are driven by earnings, and that's it. No, and it's a reality. I mean, people have talked about the Fed till they're blue in the face. The Fed causes the market to do this. The Fed causes the market to do that. Well, the market was down in 2022 when the Fed was hiking, and that's why the market was down. When the Fed was hiking into 2023, the market was up. In fact, from the beginning of rate hikes to the end of rate hikes, the market was higher. It just wasn't higher in a straight line, but it was higher because earnings went higher. Right? Hence, market goes up over time because earnings go up over time. And you say, well, what if you take that out, right? What if earnings go down? The market's potential to go higher is actually, for any given calendar year, not tied to earnings any more than the PE multiple, any more than it doesn't matter what the PE multiple is for a current year, i.e. the valuation. The market doesn't care about that for any given calendar year. Over, time, it tends to have a median reverting type of PE multiple, just like the multiple doesn't go up in a straight line. That's probably a no-brainer, duh, Seth. But nonetheless, when you look at this chart here, and this is from Schiller, earnings versus the stock market, right? When earnings are up year over year, the market has risen 72% of calendar years. When earnings are down year over year, the market has risen 77% of all calendar years. Right? I get it. You want earnings to guide the market all the time. That's just not the way it works. But more importantly, when the market has a year of down earnings, the S&P 500 actually goes higher. And that obviously would be multiple expansion taking it higher. If you think about 2019, that's essentially what happened. The multiple expansion drove the market higher. It was down in 2018. And if you think about 2018, earnings were up double digits, and we had a down year in the market. Earnings were flat to slightly down in 2019, and the market grew 31%. And again, an example whereby 2021 earnings were down. Big year, right? Stimulus, blah, 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 blah. Like, we get that, but it was multiple expansion. So just like the economy, right? Track earnings, have a good understanding of earnings, but for any given calendar year, they are not going to be the determining factor. They can help, but they're not the ultimate purveyor of what's going to happen. One of the reasons why we liked the prospects, if you will, for consumer staples here in 2026 as an investment idea that we delivered in our 2026 Outlook report, which was published in November of last year, was the fact that earnings were so terrible for 2025. This is 2025 year-over-year earnings growth, basically 0%. And we know we have, Q4 earnings to be delivered, but this is consistent with the estimate to include 2020 Q4 earnings for consumer staples, right? You want to talk about a low bar, right? That's a low bar. You're setting an extremely low bar. These consumer packaged good companies, these consumer staples companies have had, a good 3 year long period. I mean, if you think about Dollar General, you think about Target, think about Pepsi just last year. A lot of these companies, Procter and Gamble, Philip Morris, they've had a really tough go of it for the last 3 years. As in 2022, they hiked prices on the consumer. And by 2023, the consumer was done. They're like, you're not doing this anymore to us. We're just not going to deliver the same kind of loyalty to your products that we did in the past. If you don't start eating some of this cost, and if you don't eat it, we're going to make sure your stock price suffers. It's not an active thought amongst the consumers, but that's essentially a walk through what has transpired from those price hikes in 2022. And so you have this low bar that has finally been set, and the estimates for 2026 have shown a substantial increase. Where are my consumer staples? There they are. 7.2% is the expected growth. It's not by far, challenging any of the others, but on a relative to itself basis, the year ago, that is a substantial jump. How much of this is already baked in? It's anybody's guess, but we're probably not going to land here at the end of the year either, right? Analyst estimates in the back half of the year, 2H, if you will, of 2026, will probably look a lot different than versus where we are here at the beginning of the year. With that in mind, last year was very, very unusual, folks. What we had last year was the S&P 500 PE 12-month rate forward, right, looking forward, that didn't go anywhere. It went into 2025 at 22 times forward 12-month earnings per share. It came into 2026 at 22.1. We went nowhere. A flat PE multiple. Why was that so unusual? Because the median EPS growth was positive. We had an accommodative Fed as well. Usually the PE expands in that environment. 91% of occurrences whereby you had median EPS growth and an accommodative Fed, the multiple has expanded. It did not expand last year. Went up 0.1, Seth, stop. Like, don't do that to me, okay? So with that in mind, if we have a similar landscape here in 2026, all right, and this kind of flies in the face of some of my concerns about S&P 500, the strategist S&P 500 price targets this year. This actually suggests that we should get more multiple expansion this year. There's no guarantee the Fed will remain accommodative, but it's highly probable given the White House administration's pressure campaign, or that EPS growth will be as substantive as the estimates are here today. But again, more than likely, in absent a recession, these two variables are still going to be in place, and we could be looking at multiple expansion, upwards 23 times, and getting back to the cycle high of 2021, which is my base case. I am looking for a 23 times multiple, at least sometime here in 2026. And so that takes us to our grid again. In our last video, we talked about what are the probabilities of that median S&P 500 strategist price target coming to fruition? And we understood at that time the estimate, full year estimate, 2026 earnings was going to be $309 a share. Now it's close to 311, right? Basically validating my prior statement that earnings estimates tend to go higher, at least by the second half of the year. So we're at essentially $311 a share now. So here's that update from FactSet in the chart. 310.95. We're rounding, folks. Okay. So one of what I spoke to here in our macro market research report, I'll read it. Bear with me. The current full year 2026 EPS target is roughly $311 a share, which is likely to travel higher, but not materially until we get into the second half of the year. So my chief concern about some of these price targets or using the median of 75.60 was it demands multiple expansion because if it's only earnings, we're not getting there. If it's just 22 times 311, we are not going to make it. We're not going to get to 75.60. We'll be lucky if we get to 7,400. But if we do get to 23 times, how do we get, at least to $7,600 a share? So here's the exercise that we went through as well. Okay. As I've been forecasting for 2026, I am expecting P multiple to climb from 22 to 23 with earnings growth of at least 16%, right? The current estimate, or $311, is roughly 15%. I'm adding another 1%, just as a base case argument, absent, of course, an exogenous or endogenous event. If my fundamental base case is accurate and that produces at least $313 a share in EPS, the S&P 500 would achieve a minimum of 7,200. Right? That's 23 times 313, which is about 16%. That only gets you to 1,700, folks. 7,200. That's hardly the level we would need, however, to achieve the newly cemented 12-month forward price target objective of 7,500. If we plug in the median P rate of change in the table, median P rate of change in the table, however, that would deliver 7,300 S&P 500 price, which is, again, still not 7,500 hours or 7,560, the median S&P 500 price target. So what's wrong here? Like, how are we even going to get to 7,500, which is hours, or even 7,560, right? Alarm bells should be going off in your head and saying, whoa, 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 Seth, the market's a forward discounting mechanism. And that's where this chart also comes into focus, right? In the first half of a calendar year, generally you're pricing that calendar year's estimate. When you get into the second half of the year, the market is forward discounting the next year's earnings estimate, which is $358 a share, right? Substantially higher. And that's how you get these higher price targets. And so if we look at a PE of 23 times and an EPS of 358, you get 82.34 possibly by the end of the year. Hence why you have higher price targets around 8,000. Again, that's just 23. There's nothing says that we have to stop at a 23 times multiple. Having said that, there's more math to do, right? Because you're like, well, that's pricing the whole of 2027. Correct. And that's not the best way to go about defining the probabilities of a price target. The best way to do it is to take 358 minus the 310, and that gets you the halfway point, which I believe I discussed in a post. I told you to bear with me, right? Okay, so how do we get to 76? Round numbers, right? Let's deal with round numbers. How do we get to 7,600? The full year 2026 is 311. The full year 2027 is 358. So, like I said, the second half of the year, we're starting to price some of this. What is some of this? Well, it's half the difference between 358 and 311. And half of that, I believe, is 33 points. And so if you add 33 points to 311, so that's the whole of this year. That'll be the whole of this year and the first half of 2027. And that's what gets you to 7682. You take the difference between these, that gives you, so 358 minus 311, and we'll call it 33, 34 points. The year end 2026 at 23 times earnings times the 334 EPS. Now we're at 334 that we're pricing, right? That's half of this difference, gets you to 7682. The math never fails. Right? This is how you do it. You do it. Well, what if what? You can do it any way you want to, right? But it's like I've often said when it comes to investing, there's right and wrong. There is black and white. You can have 10 different strategists devise a price target objective all different ways. There's only one way to do it right, i.e., to have the greater propensity to hit your price target. And that is this way. This is the way. The math doesn't lie. You just have to do the math. Right? So, again, going back to my former video outlining why some of these price target objectives are difficult, that's with respect to understanding full year 2026 estimates. When we get into the back half of the year, we're not just done with pricing forward estimates. We're talking about 2027. And there's no guarantee that 2027 is going to look the same as it does right now. Typically, actually, this comes down throughout the year, or at least through the first half of the year. It does a lot of catch up in the fourth quarter. Same as what happened this year, right? We did a lot of catch up after the nosedive here, right? Here we are in April, tariff tantrum, flatline, nobody wants to believe, and we start rising and rising into the year end. This is probably we're going to have some degree. It may not be as precipitous as this, but there'll be some dip. There'll be some lowering of expectations, if you will. Last but not least, right? We started off this video recognizing that we are front loaded with a fantastic bullish toy barometer with a 96% positivity rate forward 12 months. Also, it has a double-digit average return of 16.5%. 16.5%. Another reason why we felt conviction so far as initiating a new forward 12-month price target objective for our Phenom Group members. We're also backloaded with a guarantee. People say, well, you shouldn't use that word. History is not a guarantee of future returns. When it's 100%, what else do you do? Right? Remember, it's about probabilities, and the probabilities are 100%. It is what it is. As an investor, you don't get paid to sound cautiously smart, right? Well, I must do a lot of risk management, and I like that guy. He does risk management. He says, history is not a guarantee of future results. That risk manager doesn't get paid, okay, in terms of returns, right? If they're skeptical, pessimistic, even fearful, that history won't repeat. And so in the back half of the year, we have a historic guarantee. Right. This is a quant referencing if you bought on the midterm election day. If you buy the midterm election day and hold till June 30th of the following year, the end of June the following year, to June 30th the following year, midterm election date, you buy. June 30th, you're holding until, and you can sell. Positive, well, you get the picture every single time. Every single time. The worst you ever did. If you bought on the midterm election day, the worst you ever did by June 30th of the following year was 2.5%. It's the worst you ever did. But the average and median, you're talking about double-digit gains. We are front loaded with a fantastic probability over the forward 12-month period, and we are back loaded with essentially a guarantee. This is also why I say it's not what you know, it's how you behave. Between now and that midterm election day, how much cash should you deploy in the event of a correction or pullbacks, so that you can deploy that much more for what has historically been a guarantee. I hope you enjoyed this video. I hope if you're not a Phenom Group member, get on board. Subscribe. For those of you who have been hesitant, you know our prices go up every single year. No need to pay higher prices. Give it a shot. Stick with us for a couple months. See if it's practical for you and give us some feedback. With that being said, enjoy the upcoming trading week, folks. Be safe and be back here next time. Take care.